Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. We're going into manufactured housing again today, but this is not a story you've heard before because Nasir Ali has been in it for 45 years. He grew up in one and learned to turn it into an asset that creates generational wealth. You're going to hear all about it now. This is episode 366 of Zen and the Art of Real Estate Investing with my guest, Nasir Ali. And I'm going to tell you right now, he goes by Ali because it just makes it much easier. So we're going to be talking to Ali, a second-generation manufactured housing community specialist. He's been immersed in the industry since 1981. He's old school like me. He grew up in his family's first park, was leasing and selling homes at 16, and now he leverages that lifelong experience as the founder of Rise360 Ventures, where he helps investors access the manufactured housing community asset class. Ali, welcome to the show.
Thank you, Jonathan. Real honor to be here with you.
Yeah, I'm excited to talk to you. We're having a good pre-call talking about what it's like to be collecting rent from people when you're just a teenager. But I want to start with what your thoughts of wealth were as a child, because you grew up there. What did you think wealth was before 18?
Wow. I have to tell you, I traced my family history back, and I was able to go back 8 generations.
Wow.
And discovering that we've been in commercial real estate for 8 generations.
Oh, amazing. Yeah.
And there's been a transfer of wealth, to your point, through that generation. And it isn't the typical wealth that everybody would think of and talk about. Yeah. It wasn't capital. It isn't capital. It wasn't, hard assets, because that was lost among, between wars,
right,
migrations, the previous Iran war crisis in the 70s, that happened where mortgage rates went to 20% and we lost our portfolio of 120 homes and had to start over. 120 homes in Orange County, single family homes.
Yeah.
And so Jonathan, the wealth you speak of was really more knowledge. It was more tenacity, motivation, ambition, more family values and morals, and thinking generational about passing it along. And so that wealth has certainly transferred. And I'm really, because you can rebuild capital if you have those elements. And I don't mean, that just sounds maybe, just cliche-ish or something, but I'm living proof, I think, especially watching my father, who's been a serial entrepreneur, rise from nothing. And so just had the blessing of the opportunity of being a sponge, really, around someone like him.
Yeah. And I mean, that's how I think it's so important for the audience to know that wealth is really a construct of where you grew up, where you want to get to. And it's different for everybody because what you need to survive is different for everybody. But to understand that wealth is much more than just financial, I think that's one of the most important things to know. You and I both lived it because I was collecting rent from single family properties as a teenager, but I was slowly starting to realize this is a great way to make money. But it's funny, I never thought it. My dad was an attorney, so he did it on the side. I never thought that was a job, but I also didn't think it wasn't a job. I thought it was a great way to make extra money. So I was thinking how many different ways can I make money? Probably like your dad and you. Were you the same way?
Oh, absolutely. That was just ingrained. I don't think I have ever been mentally just been able to accept, for better or for worse, being employable or having, having a W-2, because that was just ingrained from childhood.
I mean, an entrepreneur's spirit gets crushed at a W-2, most of the time, not all the time. But yeah, I mean, I worked for the government for 8 years. That was where I started my career. And yeah, I learned a lot. I've taken a lot of those skills now, but I was still being an entrepreneur on the side because that's what my dad did. And I still think it's fun to I want to try some new things along the way. Everyone always rushing to retire. And I'm sure you think the same way. I'm like, well, what am I in a rush for? What am I going to do? I just like to create businesses. That's what's fun.
Yes, absolutely. Jonathan, retirement is not in my vocabulary because I'm not, there's nothing to retire from. I'm not working.
Exactly.
In my mind, right? I'm not. This is what we do for passion and for fun. And we do it for our families, but I don't really think of it as a chore or a burden. Right. Yeah. And so I'm with you.
Yeah, and I think that's what people want to strive for. One thing we were talking about briefly before we got on that I think is so important when we talk manufactured housing, RV parks, it's an asset class that from the public's view has a very poor reputation, just meaning it's for poor people or something. But in the now view of investors into the asset class, it's like a little darling child. How do you deal with that? Because you've grown up in this business, you know all about manufactured housing, and there's a weird dichotomy between it being seen, as we were saying before, a trailer park or trailer trash, and as this very investable asset for outside investors.
I went from, and pardon me for being politically incorrect, but I went from being the ugly guy or ugly girl on the dance floor to being the sexiest, right. And everybody wants to dance with me now. I couldn't get on the floor, 10, 15 years ago, Jonathan. I think it's several things that are changing it. The stigma is being reduced because the quality of the home has dramatically improved.
Yeah.
It went from a trailer.
A lot of manufactured homes, people just think are home. They have no idea that it's, quote, a trailer. I mean, none. They look fantastic.
Yeah, no, I mean, you've got pitch roofs, you've got island kitchens, you've got all the amenities. You can even have an attached garage. You've got the exterior facade like a regular stick-built home. And in fact, I would argue that they're built with better quality, and better structure. So try taking your stick-built home down the freeway at 60 miles an hour, see what happens, right?
Right.
And so the stigma is being reduced partially because of that. I think the industry's doing a good job of trying to rebrand ourselves. We're not a trailer park. We are thriving communities where residents live and there's pride of ownership and you have the American dream and people watch out for each other and there's activities and, it's a community. It's not just some random trailer park. And so the home has improved. The quality of the communities has improved. The marketing, frankly, has improved. And of course, the sheer demand for affordable housing. I mean, I'm in Silicon Valley here, and, Gen Z and millennials are embracing it because you can have a $500,000 home in Silicon Valley rather than commuting, 2 or 3 hours out of literally every day, just to have an affordable home otherwise. And so, in that same area where you can buy a mobile home for $500K, you'd probably spend $5 million for a home. So anyway, I think, demand and just the sheer need is helping us as well. But, this has gone from, we were just ignored. Like I said, we were the M&M 8 Mile Park, right?
Yeah.
And now, investors, brokers, appraisers, lenders, high net worth individuals, family offices, residents, you name it. Everybody has warmed up to us. And it's really an exciting time to be in my asset class.
Yeah, I really love what you said. And I really do think the rebranding of it is very important because I think it makes it more accessible to those who might not want to tell someone, oh, I live in a manufactured home, until they see what they look like now. And not to say that there's anything wrong with the ones that look like what we used to think of as manufactured. Everybody needs a home and everyone can consider a home whatever they want and make it really nice. And, P.S., there's a lot of opportunities, like you said, they're mobile. You can take it and move it. That is something huge that may play a role in the future. And I think the rebranding of the industry and with the investor base, I think it's really smart for the country because I think community is what, kind of COVID took away from us. Everybody got used to being, just by themselves. And now like everybody who's in Gen Z, they have less friends. They hang out with each other less. Wouldn't it be cool if they all created a community and could be together more? There's a lot of things that are big pros that are built inside this asset, right?
Yes, absolutely. You mentioned something that I should touch on to clarify for the audience about the mobility. of these homes. And yes, technically you can move them and take them down the freeway. That said, once they're placed, I'm talking about manufactured homes and not the trailers that you might pull with, a truck. Those are travel trailers or park model trailers. I'm talking about actual manufactured homes. Yes, you can move them, but they come in sections on a semi.
Right.
And then it's really costly. In fact, it's cost prohibitive to move them once they're set in place. I think it still makes the point that you made, which is, because it's made in a factory and because they are mobile, they're much more affordable.
Yeah.
But from an investor, a third-party investor who's looking to invest in a community, I want to make sure they understand that the risk isn't greater because of the mobility, because it's not going to move once it, a resident may pass. The reason usually we lose a resident, frankly, is because they've passed away.
Right.
Our tenants are not like multifamily or self-storage or some of these other asset classes where they're month to month or yearly or whatever. When we have long-term residents because they've invested in a home, that's their home.
Yeah.
Absolutely. And so usually they're residents for life, and when they pass, the home doesn't leave. Still, it just gets sold and purchased by another resident.
Yeah, that's where, at least in my head, I see the difference between manufactured and mobile, even though sometimes they're the same. Sometimes mobile to me is what originally we thought of, where you can move it easier, but manufactured is intended to really be ported to the location and be solid. It's a manufactured home. It's not intent to be driving up the road, but there's that hybrid between, RV and manufactured, which was maybe the original mobile home, which was one part delivery.
So the hybrid, I'm glad you brought it up. The hybrid is what we call the park model.
Okay. Yeah.
It's the size of a travel trailer that you can easily move with a truck. And the mobile homes were still the ones that are really difficult to move and cost prohibitive. But that's why the branding was wrong and misleading. And so and I think we've done the industry's done a good job, although I don't really know if manufactured is the most, if that's the sexiest word to be advertising and branding too, but it's a big step up from what was wrong as mobile home parks, right? It's not a park. It's not mobile. So we're going in the right direction.
Yeah, that's why I like the C for community. I think that's really important because it sells off what's in there.
Absolutely.
I think people don't understand that those communities, as you were saying, some people, they've been living together for 20, 30 years. Like this is very, very common in manufactured home communities, especially in California, Florida, where, they moved in over 55 and they're just cruising along, doing great, same friends for years. And as you said, transfer. And in my opinion, actually, I've had other people on the show who said, you'd be surprised that there's more heirs who are like, I think I may take that now. Like that actually seems good. I'm overpaying for a mortgage in my area, growing out of it. My kids are gone now. Maybe I'll do what my parents did, right? It seems interesting.
Yeah, you're certainly seeing it. Wow, what a great point you bring up, because you're seeing it in secondary markets even and in primary markets, but you're especially seeing it in really high-end, expensive locations like coastal communities. Malibu or Santa Barbara is an example here. I'm in California, obviously, so I'm a little biased towards these. We have a property near San Diego, in the San Diego County and near the water. And the homes sell for $500,000 there,
the one in Malibu, they sell for like $3 million.
Yeah, exactly. But even that's a steal for Malibu. Yeah. Right. Right. Yeah. So, if you want to be around, $30 million mansions, but don't want to spend $20-30 million or whatever that range is, here's an alternative plan. And so anyway, your point is absolutely correct.
Yeah, I mean, did you think when you were growing up that you were going to do that? I mean, was it ingrained in you as like, hey, this is what we do, or did you not want to do it? Because a lot of people go both ways. I wanted to just do what my dad did. He was an attorney, so I was an attorney, and I did real estate. I just thought what he did was cool. Did you feel the same way, or were you tired of picking up the rent?
No. I was sold on it. I was a junkie. I wasn't focused in school. I wasn't focused on other things. I was just a sponge and I just loved it because, and I don't know if it's the ADHD or the, OCD I have or all these other things that we come up with we didn't know we had back in the day.
But
those are real. I I would take everything, since you asked, Jonathan, I would just take everything he said literally, and not just what my dad said. We would be on the road going to properties, as I'm sure you did, and long trips looking at mobile home parks or whatever. And back in the day, everybody talks about, well, even Bigger Pockets is maybe kind of dated now and some of these others. But I remember listening to the 70s and 80s infomercials, like Tom Vu, for example, and the tapes
Carlton
and whatnot.
Sheets, all the good ones.
Back in the day, and we would just listen to those, and even even outside of real estate, like Tom Peters as a motivational speaker and whatnot, and of course the old, Dale Carnegie classics, right? All the training,
absolutely.
And so we would listen to all those things on the road, and to your point, I mean, I was always pumped. I grew up having a sense of urgency, even in my teens. Like, I've got to do this, and I've got to do it now. I've got to start buying property. I've got to do deals. I mean, it was just ingrained.
Yeah, I always make this point because we're probably around the same age. Like when I was growing up and I'm riding with my dad in the car, I didn't have a cell phone. I couldn't pay attention to anything else. I could basically look out the window or listen to what he was saying. There's nothing else I could do. He would just turn down the music. I was a kid. I wasn't going to turn it back up. So it's very interesting. I always try to give advice to people now who have kids that are younger. It's different. You have much more challenges. Like, we're up against tiny computers, which have everything right at their hands, including videos and anything that they like. We didn't. I had to listen. Now it's more of a challenge to get our kids to listen. What do you think about that? Because I think it's hard. I love that part of growing up. I wish my kids had the same experience.
Our Friday nights were first in the evening were family meetings. Without my mom, actually, it was Dad and the kids. And Dad would say, "Hey, tell me what I'm doing wrong. Tell me what your mother's doing wrong."
Yeah. That's interesting.
It was really just very encouraging to speak up and have a voice and express and learn and whatnot. But what I want to get to is after that Friday, that ice cream session, it was always ice cream on Friday, the meetings. And then we would, late night, my Friday nights entailed, to your point, listening to my dad and reading magazines together or newspapers, Wall Street Journal, Fast Company,
Me too.
Inc. magazine, all that kind of stuff. Yeah. And just talking about it and debating. And that was my Friday night oftentimes. And so, aside from the road trips and so listening, I think there's pros and cons. I mean, I think it's really cool that the kids have all the information they need.
Yeah, me too.
And I use it every day, by the way. Also, like, that's what we're doing right now, right? This is, but there is a sense of loss of those. So there's pros and cons to both experiences, but I do certainly miss that type of engagement. It was really good.
And with mobile home parks, the thing that I always tell people that I think is so interesting, they're so easy to see. Like, almost none are gated. So if you're going to an area and you're a mobile home park investor, you can just drive through or at least drive by and get a very good vibe for what's going on. And I think now people can look at real estate online so easily that they don't get enough reps. But like, if you want to learn about mobile home parks, it's very easy. You can just look up all of them in your community. You're going to find way more than you think, and just drive right through them and just kind of see that it's different than you think, right?
Absolutely. And the beauty of this asset class, Jonathan, I think there's so many things, but the one that really stands out to me is the fact that I have all the upside of real estate, of investing in real estate, without all the typical landlord headaches.
Yeah, it's a great point. To explain why, because I think if someone doesn't know how they operate, they might not understand that.
Yeah, I think the reason why is because you're essentially renting dirt.
Mm-hmm.
Right? I'm in the business of renting dirt. My residents, my tenants own their homes. So if you have 300 units, you don't have 900 toilets to deal with, or all the walls and paint and electrical, and you can just extrapolate that to everything. The residents own their homes. They're renting the lot from you. And I don't know anywhere else in the world that there's a few countries that have this model, but really no one has perfected it the way we have in this beautiful country. And this opportunity exists here. Yeah. And having grown up in this business is great. That doesn't mean I haven't tried other asset classes or other businesses. I bought distressed other real estate, CRE, and distressed assets of all types.
Yeah.
And just distressed Main Street businesses. So it's not like I'm speaking without experience. I've delved into a number of things, and I'm second generation in this space, really, to your earlier point, by choice.
Yeah. Yeah. And I mean, the infrastructure is really what you're responsible for. Plumbing, everything that's underneath that really connects the community, which of course can be a big cost, but it's so important to note that all the residents own their home. Everything inside that home is their problem. Like, you're really not involved. You're really just involved in what the infrastructure for the community is and the upkeep of the common areas.
Which is what you would have in any other commercial real estate investment anyway.
Right.
At the bare minimum. So, you got that in any other, like, let's say multifamily. You have all of that, plus all of the issues of each unit. So we just have the basic infrastructure and nothing beyond that in terms of responsibility.
Yeah. And I think that's what makes it I wouldn't say easy, but a more accessible asset class to value, because you can get it onto a spreadsheet, and your CapEx is really going to be what in terms of the maintenance. You're going to assess, is the plumbing good? What are the connectors? But you kind of know everything up front. In a 200 unit building, you can have everybody with different levels of upkeep inside. So you may need to renovate half the units. Here, you could care less. They could have a terrible unit inside, a beautiful unit, makes no difference to you. And it doesn't change the value of the asset, because the asset is valued based on what you're bringing in from them, not on what their homes look like.
Yes. Yeah. I think, there is I don't want to misrepresent, I shouldn't understate the heavy lift up front, typically, when you buy a value add play in a manufacturer.
Well, yeah, value add for sure. Explain what a value add to you is in this space. Like, what are you undertaking when you buy one of those? What does the occupancy look like, if any? And what do you have to do to overhaul the opportunity?
So I know what I'll come back to what I think people typically define as value add.
Yeah.
Some CapEx renovations and but I'm gonna step back before your audience and say, to me, as a merchant in my blood, as a true, just a businessman, value add means any way, tangible, intangible way, all the above of how I can add value, how I can add income, and thereby adding, asset value, right? Or increasing asset value. And so some alternative ways, for example, sometimes we look at rent control ordinances that actually we can try to leverage in the landlord's favor, as crazy as that sounds.
Yeah.
Maybe we can do an appeal on property taxes somewhere.
Just that lever could change the value by a substantial amount.
Correct. Maybe it's in the financing capital stack of how we bought it versus how we're selling it. So it isn't always just CapEx and renovations and that kind of thing. But that said, typically for us and in this asset class, I think we're some of the pioneers in developing the model that's working well across the country. The value add strategy that works best is infill, what we call infill, where you're buying a community that's half full.
Yeah.
And it's half full, not because of a lack of demand for affordable housing. We know that's through the roof and only getting more, right? Where there's I think what they say, minimum 4 million units housing shortage. And maybe some would argue it's going to be double that relatively soon. And so there's definitely a demand. But the reason they were sitting half full is because the upfront costs like transportation and installation aren't baked into the financing that you can get for a home purchase for when you buy a home.
Yeah.
And in fact, there wasn't even home financing for mobile homes back in the day. We were doing all the financing too.
For sure.
Yeah. And so now there is financing available for the home, and we still do some of that. But my point is that we're vertically integrated. And this is really the business model, not just asset management and property management, but we have a dealer arm that'll buy homes to put in our half empty lots. Right. And so you want to keep it arm's length because you don't want the owner operator of the community to actually own homes or rent homes or skew the income of those homes, because now you're mixing. Yeah, this is a bit of a tangent for the audience, but I just want to clarify that home is like personal property, since ultimately the homeowner is not going to own the land underneath it. It's not fee simple.
Yeah.
And so therefore it's treated much like your car, it depreciates like your car. It's personal property. And so if you start skewing income or from sales or rentals of those homes with the real property, the community, now ultimately you become unbankable, really.
Yeah. Interesting.
And so you want to shy away from that. And that's why everything's kind of arm's length, separate entities, but still vertically integrated, so that not only do you have property management and asset management, but you have the dealer arm that's buying and selling homes. And then where it's applicable, where it's legal, and check your own state and check with your own lawyers, but providing financing for those buyers, those retail buyers of those homes.
Yeah. That seems like a super idea if you can, because it's again not widely available. Certainly was not available at all in the past, and now is a great opportunity for people who can get affordable housing with a mortgage that they can deal with, and long term it looks good.
And I might add those rates, market rates for those homes, like is at least 9 to 11% from primary lenders, and even higher by secondary lenders, which theoretically is higher risk. But in terms of the risk profile, I don't really see it as risk, and most operators like me don't, because you can, if someone doesn't perform on a loan, you can slap a lien on the house.
Right, and they're not taking the house anywhere.
Thank you. Yeah. That's exactly right. So if anything, if someone defaults, you're actually having an opportunity to sell it again in a market where the affordable demand is huge, right, across the country. So it's not any real risk, but on paper it is risk, and therefore we're always typically about 3-4 points higher than typical stick-built mortgage rates. Yep. So, if the market's at 6%, we're going to be at least at 9%.
Hey, it's Jonathan. I hope you're enjoying this episode about manufacturer housing with me and Ali talking about the generational aspects of it. But if you want to get more info about what they do at Rise360 Ventures, go to rise360ventures.com. Right in the middle of the homepage is the report that we talk about later, Investor Guide, How Investors Generate Passive Wealth Investing in Manufactured Housing Communities. Get yours. Now let's finish the show.
You brought up a good point before also about this kind of operational redo. I think that's really important, because I've invested in a few multifamily syndications, and they're not knockdown renovations. They're basically just operational overhauls. So you can pick up parks for a lot of different reasons. Just because it's in quote distress doesn't mean that the homes and the community is in bad shape. It means that they could have just been a terrible operator, as a lot of mom and pops they actually get good at it. Then they get too good, and now they're like, oh, this is too much work. I just can't keep up. And then when you buy into those, like you said, all you can do is you make a tax appeal, boom, you get a big thing. That can raise the park $1 million value. People don't understand the lever across all of the homes. What happens when you make these little changes, or you find out that they were, had terrible water problems because of something, in the water, and now you fix it and it saves, hundreds of thousands a year.
You just got to be able to think literally outside the box and get creative. I mean, I bought I can think of a deal, and my father has done much more than I have. But for example, even in 2005, I bought an income property with $2,500 down, and I sold it for 7 figures 6 months later. And my total purchase price was about $25,000, and this wasn't out in the boonies or something. This was in Southern California. In a primary market. And so, it was just because I saw an opportunity that the existing owner couldn't see.
Yeah.
And anyway, that's exactly what you're saying is exactly right.
Yeah. I mean, most of real estate is identifying opportunities that others can't see, or else you're always bidding against other people. And I mean, I wouldn't tell a first time investor to go, find the needle in the haystack. But for people like us, that's the fun of it. I personally like when I flip, which is rare now because it just doesn't make any sense. I flip weird houses because I know I can fix. No contractors want them because they just like a McMansion type of layout.
Right.
I like the weird ones, and I know when I go to sell it, it's not for everyone, But for the people it's for, they're going to go crazy over it because they like the weird stuff. And that's what's fun about real estate. Yeah.
That's fascinating. That's really interesting. I don't think I've heard too many people say exactly what you just
weird,
said.
But I like weird assets too. Like when people bring up things that I don't know a lot, I've become really interested in manufactured homes, just a thing, partly because of what we were talking about before, and we've talked about a little. It's such an interesting asset because of what most people think of it. Maybe not anymore, which is great. But it's just like, when you're growing up, I'm sure you didn't think like, oh, the biggest wealth building mechanism in my life is just going to be, manufactured homes and RV parks. I don't think anyone would grow up thinking that. Maybe now, I hope people do, but it's really interesting that you can find more asset class that like a lot of industrial looks like that to me. You look at it and you're like, just a pile of dirt,
Yeah.
What's it going to become? And then you see how it can make money. And it's very interesting as a business.
Now it's becoming more and more known or popular to invest in boring, non-glamorous things.
Yeah.
But yeah, when we were coming up, it was just boring and non-glamorous. Nobody wanted a piece of it, right?
Well, because there was no social media to show, and it's just funny. I mean, people want to show what's flashy, but if you just think about Warren Buffett, I mean, he's always been a boring investor. Everybody, that runs like him and Charlie Munger did, just boring investments. That's what makes money over time. Strong, solid, good foundation in all ways. And you figure it out along the way. The longer you hold it, no matter what, it's likely going to go well in America.
Yeah, I'm not much of a gambler anymore, but when in my 20s or 30s, when I played blackjack in Vegas a lot, I used to play a very boring blackjack game, Jonathan. And I don't know if you play blackjack, but if the audience is listening or whatnot, I would drink my coffee and I would sit there for hours and I would just wait for the double downs and the splits,
have the rules. Yeah.
Yeah. And, of course, the lights are on for a reason. I'm not saying I figured out Vegas, but I am saying, I'm just saying that was the best way to improve your odds was to be patient, play a boring game, wait for the right opportunities. When you got them, take action.
Yeah.
And hope for the best. And, a little bit of luck also helps, of course, but it was those double down and split opportunities where you could get, have your value add play, your increase, right? Yeah. And so, and to be patient for those. So I think in some ways, it resonates here. It's
absolutely. I mean, to me, patience is the key to wealth. And I think the younger generation, just because social media looks like everything's quicker and easier in 33 seconds, it's just harder for them to be patient. They have more things streaming at them all the time. But like you were saying, but for us growing up, we didn't have the internet. So I'm riding around, we're both riding around with our dads, looking at businesses. And I used to see cash come in. And kids don't even use cash anymore, but I used to watch a tenant hand my dad $1,000 and I would be like, holy crap, that's awesome. Just because I saw the money. It's so much different to see money. And then it was harder when you just see a check, but at least you can see how much it's for. Now it's just a Venmo transfer. It just exists in the ether. But I've been doing a lot of financial speaking. The kids don't understand money because they don't see it anymore. I don't even use cash. Most of the time someone's like, oh, it's cash only. I'm like, I don't remember the last time I've even been to an ATM. But do you remember seeing cash in the parks as a kid and being like, you understand the transfer better because you can see someone paying for a service or for a product right there.
So let me share a quick story that'll capture that and more that I think would resonate, that would be helpful to the audience. Just a few weeks ago, I guess, July 9th, we just celebrated our 45th year anniversary of being in this business.
Congrats.
July 9th, 1981. And we bought a KOA to start with. It was an RV park, not a mobile home park, but we started with an RV park. And we actually put in some permanent units in there and quickly figured out the business model of being in the mobile home park business. But the point I'm going to make to your comment is that, back then, I remember we had come off the original Iran war crisis. And like I said, the mortgage rates had gone to 20%. We lost our portfolio. Yeah. And here we were starting over, living in the park. So I lived in a trailer. I went from a McMansion in Orange County to living in a trailer, Jonathan, in this trailer park. And I remember long weekends like 4th of July, where we would where cash would come in, all this hard cash would come in, and we would save up the money for the mortgage payment. And we knew that every month we had this huge mortgage. And in today's dollars, I mean, I don't know, it'd probably be like $12,000, $15,000 a month,
Yeah, that's a lot then. Yeah.
It was a lot. And it was a big mortgage. And so, but I remember this, we would save the long weekend money, and my dad he just had this ability to count cash, like with his little index finger, just go through it like this, like it was like a machine counter. Yeah. And he would just be verbally like counting, and he's just using his finger. And I'm just watching this, and it wasn't like thousands. It wasn't $100 bills the whole time. Of course, it was, 10s, 20s, 50s, 100s, whatever. It was all mixed up. But the way he could just go through it and get a deposit ready, to race to the bank to make that mortgage payment, because that was such a big focal point for us.
Yeah.
It's still fresh in my mind today.
Yeah. I mean, where do you think it comes from, though? Do you think because you went from the McMansion to the RV park, that motivated you to say, like, hey, I don't want to live my whole life in an RV park? Or did you just appreciate the opportunity? It seems like you were just motivated from your dad, like I was. I just thought making money looked cool. I didn't really want like the cars and anything. I didn't even think about it like that. I just thought it gave me more opportunities if I had more money.
Yeah, no, I didn't see it as a hardship at all. Sure, there were some challenges. The park wasn't in the best part of town. I didn't get to play football or go to the prom or those things. But I didn't see it as a real disadvantage. I saw it as, and I was just so like excited by it. So I'm like you. I didn't really worry about the fact that I was I was 12 when we moved in to that trailer park. Mm-hmm. So originally my work was moving picnic benches around and clean the pool and that kind of stuff. It wasn't until 15 or 16 that I started running the store and buying and selling trailers and that kind of thing. And by 17, 18, buying property. But just that experience was, to me, I didn't see it as a setback. I saw it. I mean, it was like you said, it was just all the teachings from Dad and what he had passed down from his father and previous people. I won't go into detail, but if anybody wants to know more about it, they can reach out. I mean, my father bought property with no money down back in the old country, just because he was creative. And his father got into a business, and I'll be real brief about this, Jonathan. I'm not trying to get into a history lesson, but his father was came into a new city after the war with 7 mouths to feed and no opportunity for employment or anything. And he was told by some friend, hey, I know this distributor of soap, and if you want, you can go talk to the distributor. He sells soap to the retail stores. And, so he goes and talks to the distributor. Distributor says, hey, we've already got reps everywhere for all the stores. I don't know who you're going to sell to, but if you want some soap, you can have it on wholesale, on consignment, and it's a 90-day cycle. So my grandfather takes the soap, and he finds that he can't sell it anywhere because everybody already has the relationships and everything, until he starts selling it at zero profit. He sells it at cost, and he starts selling a tremendous amount of soap. Yeah, he's not making any money, but he's selling lots of soap, and suddenly, he's got cash. It's not profit, but it's cash, and he has 90 days to turn that cash around. So he starts making shorter term investments with that cash, which is incredibly risky. Yeah. But 10-day turnaround, 20-day, 30-day cycles or whatever, he's turning that soap around. And he started doing so much volume. Jonathan, these soaps, the soaps came wholesale. They came on a rod, a wooden rod. Like the bars would be on a rod. Yeah, yeah. And he was selling so much soap that he gathered so much wood. And that wood became became his profit center, where that he was selling the wood or recycling the wood.
Smart though. I mean, it's just being in figuring out what you have and it is risky though to make the shorter terms, but if you have enough volume, you can cover the ones that don't work. It's like mini startups.
Right. And he was doing safer. I mean, he wasn't going and gambling, cards or something. Yeah. He was doing something safer. But the point is that he had 7 mouths to feed, and he found a way with whatever resource he had. And, before you know it, the wood was a source of revenue. The the shorter term investments was a source of revenue. And then ultimately the soap was too, because once he had the relationships and he could start ratcheting it up a little bit, ultimately the soap became profitable too. And I'm here in this beautiful country today because of my grandfather and my father being able to turn things around.
But I can see that relating to manufactured home parks, because if you get in and it's not as good and you do the operational improvements and then, what you're charging just goes up a little bit, just a little bit across 100 units, it's gigantic. I always think of that, someone says, oh, on a 5-unit building, it doesn't move the needle. But what about on a 200-unit building? When you just charge now for, I don't know, some amenity that you bring in, and then you get $40 each. And then when you add it up, you're like, oh, okay, our value just went up $1 million. It's crazy.
Yeah, but I can see some of your audience. I would think some of your audience might be thinking, okay, that's great, Jonathan and Ali, but how do you get into the park in the first place?
Yeah.
How do you buy it? And I'm here to tell you that I know it's so much harder today to buy with no money down or little money down and do creative deals. But I also believe it still can be done.
I agree.
Yeah.
You need to find the right seller to make the creative financing possible, and they need to be in the right mindset. But yeah, I for sure, I actually think it probably exists more in the mom and pop mobile home space, because it's to me, creative finance is, what are they going to do with their money? What are they going to do with the tax burden? And they don't want it. No one wants the tax burden. So if they don't want the tax burden, now you're into a conversation about creative financing. So if they've owned something for cash for a long time, here you go.
That's another lesson. I'm so glad you brought that up. It's such an important question that you just asked that the audience should think of and always ask. I always ask a seller, hey, when I pay you this, what are you going to do with the money?
Exactly.
I've bought businesses before with no money down, because I discovered, when I asked that question, I discovered that they had a ton of debt they were just going to pay off.
Right.
And, on the business and otherwise.
Yeah.
And they allowed me to assume that debt.
Oh, and some people don't want to even leave the business. They want to sell the business and then they're just going to work there. Like, okay,
right.
Now I really don't have to do anything,
Right. Or I think you were alluding to earlier, maybe they don't want to pay capital gains tax from the sale. Yep. And whatnot, as an example. So that maybe they'd prefer receiving it in installments. Maybe they'd prefer a lease with an option to purchase. So it's not even considered a sale until later, and so you can get creative.
But that's the question. What are you going to do with the money? Like for me, if you're buying single family homes, I would tell everybody, listen, when you're off market, you can do whatever you want. But if you don't ask them where they're going, you're not buying the house. If they don't know where they're going, you're not buying the house, because where are they going to go? They need to live somewhere. You need to help them figure out where they're going to go. And if you can do that, you can buy their house. But it's going to take a process. And that's what creative financing is really all about. It's building relationship, figuring out where the leverage is, and figuring out, like you said, what are they going to do with their money? It could be a lot of different things. But like you said, now you're pulling different levers with the leasing option also. There's a lot of different things to get creative at that. And I agree with you. I still think people can do it.
I think of, and you're making me, all these different thoughts are coming to mind, right? I mean, two thoughts came to mind. One, the playbook. What playbook are you following? And I'll come back to that. But then what you just said was really, I think of real estate as a white canvas, Jonathan. Like if you can understand the situation what a seller is under and where there's an opportunity, if you see where the value add is or where you can make money, you just start with a white board. And you start structuring all these elements together. Right? This is a challenge. This is where the upside is. This is what the seller wants to see. And then you go and figure out how to legally structure it. Whether it's going to be equity raise, whether it's going to be debt, whether it's going to be maybe a triple net lease for a while with an option. You figure out the structure, you get the legal help and all the other structure later. But first figure out just the core underwriting, so to speak, the math and the deal. And then the other thing I was thinking about when I said playbook, I want to just mention, because we're living in some crazy times again, right? We're in another, I don't know, it's a crisis. It's not a war, right? And so,
right.
And so, where we could potentially go and see hyperinflation again.
Yeah.
And mortgage rates go to, some crazy numbers, like we saw 17, 18, 20% back in the late 70s, early 80s. That all could be coming. And not to scare people, I think for shrewd investors, for people who are ready, there's going to be an opportunity. But the playbook point that I made is that you may not be able to follow the playbook from previous examples.
Exactly.
I think you have to be able to sit down, really understand the fundamentals, or get with somebody who does. And, maybe you need to write a new playbook.
Yeah.
Are you capable of that?
It's a great point. I always make the joke because people will say they'll read the Burr book for Bigger Pockets from like 7 or 8 years ago, and then they think it still applies. I'm like, it doesn't apply. That applied perfectly, at 3%. Now you can't do it. The numbers don't number. It doesn't mean that the framework is wrong. So you apply the framework, and like you said, now you're going to put your own spin on it. But really, in the end, don't you think that most acquisition, when you're dealing direct, it's really just about solving problems? We were saying, like, you just need to find out, maybe it's not like a problem they don't have to sell for a lot of mom and pop owners, but they're not in the conversation unless they want to. So now you have to figure out, like, what's the deal? Like I said, where do they want to go? What do they want to do with their money? Do they have an emotional attachment to the place? Do they want to stay on, especially for businesses? But there's so many different things to figure out. And I think you made a great point. You figure out how to get it done, and then you bring it to an attorney or someone who can help you make it the correct way so it's legal and suits everybody's needs. And then you're in a win-win situation, which is what you're always looking for.
Yeah, I think it's important to have the professional advisors, particularly legal, but they can't. I don't believe in having them write the business rules for you. Yeah, and that's I think the point you're making, right? Yeah. Is you have to come up with the business rules, the business logic,
and then tell them to make this work.
Make it work. That's right.
Yeah, I think it's interesting. I think it's cool that you've played around with different asset classes. Are there any other asset classes or businesses that you might be also interested in now?
So I've always been fond of, parking, self-storage, and mobile home parks, because they're really the same business model.
Yeah. I love parking. Parking's just super interesting to me because you just need, talk about a business on dirt. Like, that's it.
When I mentioned the deal earlier for $2,500 down, it was actually an airport parking business.
Oh, nice. Yeah.
Yeah. And so it's the same business model. You have small areas of real estate leased for short periods of time for the maximum revenue per square foot and maximum efficiencies, and hedging your bet over a number of many more units, relatively speaking, than other asset classes. So for all those reasons, I love it. The reason I don't invest in those as, really, I invest in housing, because mobile home parks in particular, because, especially in these times, I believe you need to be in hard assets, which we all agree with, CRE. And then within hard assets, you need to be in essentials. Something that I've always believed in, that's been ingrained by my dad, but essentials, shelter is an essential. And then of course, and then within essential, within shelter, we're in the most affordable form, right, of the American dream of home ownership. So when you asked me earlier, hey, did you think that when you were a young man, did you really think this is what you were going to do all your life? Yes, I did. Because I was taught early on that this is an essential, and in fact, got to live through many cycles, downturn cycles, where I saw our business increase.
Yeah.
But anyway, going back, increase in the downturns, I should say.
Yeah.
So the .com bubble, the savings and loan crisis before that. There's a bunch of them, right? The 2008 and the pandemic and all the ones that I'm probably forgetting right now, but at least 9 different cycles, downturn cycles, where we saw our business pick up. And so, have I done other deals? Yeah, I didn't care what the widget was. I bought distressed businesses regardless of the widget, because at the end of the day, I'm looking at a spreadsheet. Yeah. And as long as there was a distress or a value add play that I could see in the numbers, and as long as it wasn't a rocket science business that was beyond my comprehension,
right?
I didn't care what the widget was. And so I remember buying a deal, like I think I was kind of alluding to earlier, where, again, no money down, just 2 partners who were almost ready for retirement. They were burnt out. They weren't making any money at the business because shrinkage. The manager or somebody was stealing all the money. It was really the manager in that case. So the manager was stealing all the profit, and they weren't making any money, and yet they still had all this debt on the books that they had assumed. And so I got to take over for no money down. It didn't start that way. It took a while to kind of negotiate that. But by the end, I bought the deal for no money down, and I had instant profit. I had instant cash flow because I knew I could understand the numbers and see where the shrinkage was happening.
Yeah.
And so for them, what was a lemon turned out to be lemonade right away for me. Yeah. And you can find those deals. You can get in. And even if you don't know how, or you don't have money to just be upfront costs, and you don't understand how the dynamics work to get to a close, these things are, reach out. These things can be done. They can be managed. It's just a little bit of insight.
Yeah, it's why everybody who wants to be in the field needs to know people in the field. I mean, you need to surround yourself with people who are doing deals before you are, so you have someone to share a deal with or say, hey, can you help me get this done? Investors love to help other investors. The public perception of investors is so crazy about what they think about like landlords and investors. All investors want to help people, and they like talking about what helped them get where they are because they believe it can really help somebody else. Some people... Yeah. Feeds the ego, sure, but there's no reason to talk about it unless it's going to help someone else do something similar.
Well, that and let's face it, I don't know about other industries or whatnot, but our business, as you well know, this is a people business.
For sure, 100%.
You do business by engaging with other people. We offer in the Bay Area here, we offer a not-for-profit. We've set up a meetup called Rise, separate from our company, Rise360 Ventures. Rise, real estate investing. Action, a verb there, real estate investing strategies, right. And education. And so that meetup, in fact, it's next week. We do it, once a month and sometimes twice a month. And it's exactly for what you said. It's just bringing people together and just networking and helping each other do deals.
Yeah, I did them for 4 years here in New Jersey. And then last year I stopped so I can focus more on this and create some other things like that and maybe some bigger events instead of the monthly. But yeah, I found that the easiest way to gain the confidence to transact is to know other people who are transacting, Analysis paralysis isn't real. I'm sure you believe it because you grew up with a dad who got things done. It's just, you just don't have the confidence to do it. But I don't think you can get the confidence just from podcasts and books. You need real people who seem just like you, who just go and do deals. It's always, this, I always make this joke because at the meetups, it's like the new people are like, oh, people are going to, come in dressed in suits. And then it's like always the guy in a ripped shirt and Crocs in the corner. And they're like, hey, can that guy pick up the plates? And they're like, he owns 75 units.
Right. Exactly.
Like that's real estate investors because that's how we grew up. My dad was in tennis shorts and a tank top all the time.
Yeah. No, you nailed it on the head. That's fun. Exactly right.
Yeah. Awesome, man. So is the best place to find you guys at Rise360Ventures.com?
It is. It's also the best place to get a free detailed report about investing in manufactured housing communities. We have an 80-page report that our marketing team has put together in comparing this asset class to others and why this one wins, in our opinion.
Yeah.
And so that's complimentary. You can go on the site. You can also find us all over social media, YouTube, LinkedIn, Facebook, everywhere.
Yeah, if they go to Rise360Ventures.com, I see it right on the homepage, right in the middle, Investor Guide, How Investors Generate Passive Wealth Investing in Manufactured Housing Communities. And then there's a link, access the report, and they're good to go.
Yes, sir. That's
awesome, man. Well, I really appreciate it. It's been a great conversation. I love talking history of people who got dragged around from their parents and enjoyed every minute of it. So thanks so much for spending the time.
Thank you, Jonathan. By the way, I love the name of your podcast. My son's name is Zen, by the way.
Oh, that's awesome. So,
yeah. I just wanted to share that with you. And thank you. It's been a real honor to be with you.
Amazing. It's my pleasure. All right. That was Nasir Ali. You can call him Ali. Rise360Ventures.com is where you can find him. I'm Jonathan Greene. We'll see you next episode.
Thanks for sticking around to the end so you can get a preview of who's coming up on episode 367 of Zen and the Art of Real Estate Investing. It's Cheryl Scheidel, and we're talking reverse mortgages. This is her thing, and it's something that we have not talked about in all of the previous 366 shows. We're going to talk about what they are, who gets them, how they help or hurt the heirs, and how investors can buy them, because reverse mortgages are an interesting buy, but they're also really something you need to learn more about. We'll do it all next episode with Cheryl.